Okay, so here for this section, or this video, we're going to be discussing the management's responsibilities throughout the audit, and this is in section 200.05. So it says the financial statements subject to audit are those of the entity, prepared and presented by management of the entity, with oversight from those charged with governance. GAAS do not impose responsibilities on management or those charged with governance, and do not override laws and regulations that govern their responsibilities. However, an audit in accordance with GAAS is conducted on the premise that management and, when appropriate, those charged with governance have acknowledged certain responsibilities that are fundamental to the conduct of the audit. And the audit of the financial statements does not relieve management or those charged with governance of their responsibilities. So let's go into a little detail of what all of this means. And so first of all, when coming into this audit engagement, management is implicitly acknowledging and explicitly through the signing of an agreement and an engagement letter, they're agreeing that their responsibility in this audit and before the audit has been that they prepared and approve of the financial statements under an applicable financial reporting framework. They're the ones who designed and implemented and maintained the internal controls around the preparation of those financial statements. And also throughout the audit, they have provided unrestricted access to the entity's personnel as well as the information that might be pertinent throughout the audit. And so before the audit begins, management and the auditor will be required to sign an engagement letter that sets out management's responsibilities, as we just discussed, as well as the auditor's responsibilities. And so the financial statements subject to the audit are prepared and presented by management under an applicable financial reporting framework. So we need to understand exactly what is a financial reporting framework. So these are typically the rules or laws set forth by either accounting standard setters or government laws. And they direct the form and content of financial statements. And they typically just set broad principles as opposed to standards that would say how to account for every single transaction, but instead more broad principles that could be carried over several different types of transactions. In most cases, the framework also dictates what constitutes a full set of financial statements. So for some frameworks, that might mean the balance sheet, income statement, cash flow, and equity statements are a full set of financial statements. And other frameworks might say that a single set of financial statements and the applicable footnotes include a full set of financial statements. So each framework is a little bit different in the form and content of the financial statements that they cover. And the major financial reporting frameworks for general purpose frameworks include the Accounting Standards Codification that's issued by the FASB, IFRS that's issued by the IASB, Statements of Federal Financial Accounting Standards issued by the Federal Accounting Standards Advisory Board for U.S. governmental entities, and statements of the Governmental Accounting Standards Board for U.S. state and local government entities. So now that we understand what are the applicable financial reporting frameworks, let's try to figure out, well, how does management implement this framework in the preparation of their financial statements. And so management is required to exercise some professional judgment here with this. First of all, with identifying the applicable framework that they need to use, then by implementing that framework in the presentation of their financial statements, and finally by including a description of that framework and a footnote in their financial statements. And management may prepare their financial statements under a general purpose framework, so that would be one such. It meets the needs of a wide range of users, and that might include GAAP or IFRS. They can also use a special purpose framework, which is geared toward a narrower set of users, and this might include the cash basis, tax basis, regulatory basis of accounting, etc. Now it says here that the financial statements are those of the entity and prepared and presented by management, but actually the auditor can make suggestions or advise management on the form and content, or even prepare the financials in whole or part based on information provided by management that goes into those financial statements. But as we've seen in prior videos, the auditor's responsibility is for the opinion on the financial statements only. They don't have a responsibility to prepare the financial statements or present them. We see here that responsibility is management's. So we'll dig into a little bit more of the financial reporting framework and determining that framework in section 210, terms of the engagement, and also section 800 tells us a little more about using special purpose frameworks.